Today on the Invested Mindset, we're going to be talking about the state of the market. My podcast was designed to help new and seasoned investors and entrepreneurs break free from financial confusion by sharing real-world investing and business strategies they could use to build lasting wealth and freedom. Well, all right, let's talk about the state of the market today, May 19, 2025, and we've got a lot of stuff going on. So the word of the day today is fear. I think of all the words to describe what is going on right now, it's fear. Now, if we take a look at why am I saying that? Why fear? Well, look at the stock market first of all. If you want to see fear, there's not a lot going on there. I pulled up the ticker today a couple of times, and literally the Dow Jones Industrial Average was not up. It was not down. At one point, it said that we were up 0% and down 0%. It's not normal. That is not normal at all. It's always up or down, one or the other. But today, nothing, absolutely nothing. Also, May 16th, Barron's article came out about consumer sentiment survey. Now, that just came out 3 days ago, and it is the second lowest in recorded history. Consumer Sentiment Survey, what is that? It is a survey that asks a whole bunch of people, well, how do you feel about the economics of the country right now? How do you feel about your personal economics? And when consumer sentiment is bad or down, that's a bad thing for the U.S. economy. Why? Because about 70% of the U.S. economy is consumer spending. So if people are not feeling good about what's going on or what they think is going on in the economy, they're probably not going to be spending as much. And if they're not spending as much, we're not hitting the GDP numbers that we need for a healthy economy. So the Consumer Sentiment Survey is down to the second lowest in recorded history. Now, for reference, this survey was started in 1978. Okay, it's not like something that just started 5 years ago and we just hit a second to lowest number. No, this thing has been out since 1978. Okay, the only time since 1978 that consumer sentiment has been worse than it is right now was in June of 2022, when inflation hit a all-time high since the 1980s of 9.1%. So why is everybody scared? Let's agree that everybody's scared, right? The vast majority are scared. Why? Well, 3/4 of the people in the survey said tariffs, or as the mainstream media calls it, Trump's trade war. That is what people said they were worried about. They're worried about that the most. So we're going to dig in a little bit about the tariffs and the trade war, if that's what you want to call it. We're also going to talk about interest rates. We're going to talk about inflation. We're going to get into government spending and DOGE. We're going to talk about all of those things throughout this episode. So the first thing that I want to hit, though, other than the consumer sentiment survey, is the Fed funds rate. Now, just after this consumer sentiment survey came out, traders on Wall Street have placed the chance of interest rates being held at current levels in the June meeting or after the June meeting here next month at 95%. 95%. Only 5% think that things are going to be changed in the Fed meeting. So That's why people are scared. They think everything is going to be status quo on rates. They think rates are extremely high right now. They think that all these tariffs are going to spark inflation. I don't know what they think, but those are some of the things that people are saying. So let's talk a little bit about the inflation rate. Or no, let's start. Let's finish this consumer sentiment survey off first, because I've told you it's the second highest or second lowest on record, meaning people think that we're in the second lowest place financially that they have seen since 1978. Well, I beg to differ with them. There have been a lot of times, I think, in retrospect, we could look and say, oh, no, this was a way worse situation. But that's how people feel. Now, to give you a context, from January of 2015 all the way to February 2020, the consumer sentiment survey was somewhere in the high 70s to 101. Okay. Then inflation hit in June of 22, and the consumer sentiment fell all the way to 50. Then it went from there and kind of meandered up to 79. And then in December 24, it was sitting still at 74, and then started this steep and steady drop to today, where we are sitting at 50.8, barely over the June 22 reading that was the worst since 1978. Now, we got to get into why. Why are people so scared right now? I think there are several things, and we're going to hit them all. The first one is interest rates. Now, I talked about this on a recent podcast. I don't personally believe interest rates are historically high right now. You need only go look at the history of the 30-year fixed rate mortgage in the United States, and you can quickly find a chart that goes all the way back to 1974, and you'll find that currently, I think the 30-year today is sitting at somewhere in the 6.8, 6.9% range, and that is relatively on the low side of normal historically. But since we haven't had a normal interest rate since probably 2007, most people today, particularly the largest cohort of home buyers, the millennial generation, they've never seen a normal interest rate. So for me to sit here and, pound the table and say this is a normal thing, this is a historical normal, this is not a high rate, doesn't matter. They've never seen a normal rate, and to them, this is high, because, hey, they locked in their rate several years ago, and they have a 3.9. So today's almost 7 is high to them. It's double. And I get that. But as I said before, and I'll say again, we don't currently have an interest rate problem in this country. We have an interest rate perception problem. Most people just have never seen a normal rate. Those of us that were adults in the 1980s, which I was an adult in the later 80s, but in early 80s, those that were adults then and buying houses like my parents did, they were comfortable paying 16%, 18% for their mortgage. I don't know if they were comfortable, but they certainly did it. So those are the two extremes. My parents' time, buying in the late 70s, early 80s, and paying in the teens, high teens. And then my kids, who have seen 3 to 5% mortgages as normal. So we have got this interest rate situation, and the potential, at least all the traders or most of the traders are suggesting that interest rates are going to stay the same after next month's Fed meeting. And I've been saying for 2 years not to expect any interest rate declines of any substance, because I don't believe we need it. I don't believe we will see it. And I stand by that today on this podcast. I don't think we will see much in the way of a rate decrease, maybe even for the rest of this calendar year, but certainly not in June. So we've got that. And then we've had the Moody's downgrade of the U.S. debt. Now, this is something that has followed a couple of other rating agencies a couple years ago, S&P and so forth. They downgraded U.S. debt and said that it's a little riskier than everybody thinks it is. But Moody's kind of held to where they were. But last week, they also downgraded. And the reason they downgraded, whether you agree or disagree, is irrelevant. The U.S. government currently in fiscal year 2024, and it is expected to be much higher in 25, spent $6.8 trillion with a T dollars. Now, in that same fiscal year, the U.S. government brought in revenues $4.9 trillion, which is a deficiency of just under $2 trillion. Now, I know we get our millions and billions and trillions all mixed up, and it's hard to tell what's what. But a trillion is a bunch. A trillion is not something to be messed with. And we're missing 2 of those every fiscal year and increasing. And that's the problem, Moody's says. And that's the problem, according to the other rating agencies last couple years ago. They said, look, you can't continue to spend more than you bring in. At some point, there is going to be a reckoning. And who can argue with that reasoning? I can't. I know I run multiple companies and I've run a household for quite some years. And I know I can't run my house this way. If I am $2,000 short each month, eventually I'm going to have more debt than I can pay back. In my companies, if I'm $200,000 a month short, at some point I'm going to have more debt than I can pay back. I mean, this is just common sense. The problem is Washington doesn't have enough of it. It doesn't have enough common sense. And I got to be honest with you, I don't think in today's environment or in the last 30 years, 40 years, there has been enough will on either side of the political aisle to tackle this. And I don't think there is currently today. Now, we're $2 trillion, give or take, short every year, every fiscal year, in being able to pay our obligations, those things that we have passed through Congress and have agreed to pay. So those 2 trillions just keep stacking up and stacking up and stacking up. And what do we do with those? Well, those have added up to $36.2 trillion in debt. Now, if you were to look at this like a credit card, you could say easily, in my house, I am $2,000 short every year. And now I owe $36,000 on my credit card. But every year I'm 2,000 more short and increasing every year. It's increasing fast, guys. It's not just a little increase. Just in January of this year, we were only 35.8 trillion in debt. Now, 4 or 5 months later, here we are at 36.2 trillion. That's a lot of money. That is a lot of money. And there is no will at all in Congress to stop the spending. This is why our debt got downgraded. Pure and simple. Was it downgraded enough? That's my question. I don't know, because I don't see anybody trying to fix it. Now, we could say, well, yeah, but hey, we got a new administration. And, you know, they're making some changes. We're going after waste, fraud, and abuse. We've got this thing called the DOGE, right? The Department of Government Efficiency, and they're saving us a lot of money, so we're okay. Well, no. Doge is great. I love the concept. I love what they're doing. Absolutely love what they're doing. And it needs done. But there's a couple of problems with it. So far, and this morning I went to the Doge website to see how much have they saved? How much have they told us they've saved? Now, there's a lot of speculation about whether these numbers are overinflated, whether they are calculated properly, but let's just take it on its face and say that it's 100% exactly the way Doge says it is, and they have currently and so far saved the U.S. taxpayer 170 billion with a B dollars. That is nothing in comparison to the 2 trillion with a T dollars per year we spend more than what we bring in. It's a drop in a bucket. It's a rounding error. And yes, it makes for good politics. It's great meat for the conservative base. But in the end, it is not a fix. Now, granted, I hope they keep going. I hope they can find 2 trillion over the next 10 years, which is how they're calculating it. They're not calculating it annually. But I hope they can find trillions of dollars over the next 10 years that they can cut. But there is no way they can cut to the degree that we're spending. Now, that brings us spending. Brings us to the next thing. Fox News article, actually, that's not correct. Fox Business article this morning. White House National Economic Council Director Kevin Hassett. There's a great article on there talking about how the current administration thinks they're going to tackle this debt problem. They're not going to stop spending. In fact, if you look at the big, beautiful bill, that 1,100 or 11,000 or whatever this monstrous bill is, pages is working its way through the House right now, you can see there is no hope whatsoever. This is a 100% Republican bill. These are supposed to be the fiscal hawks. These are supposed to be the people that are less spending, less government, push things down to the state and local level, more freedom. That bill does not say most of those things, okay? That bill has us spending more in the next year than we are this year. But Kevin Hassett says, yes, there's fear in the market. Yes, there's turbulence. Yes, there's turmoil. But there's 2 things that you're going to see in the very, very near future. And my read on it, he was talking within weeks. You're going to see a lot of trade deals, and you're going to see clarity on tax cuts. Well, let's talk about that. You're going to see a lot of trade deals, and you're going to see clarity on tax cuts. Guys, I think this is really where the Trump administration is going in an effort to tackle the debt situation. They're not going to try to cut. They're not going to try to cut expenses. They're not going to try to cut much out of anything, to be honest, other than what they can consider waste, fraud, and abuse, because that has a broad constituency. There aren't very many people on either side of the aisle that could be okay. I mean, yeah, you get your fringe, but there's not a lot of people on either side that are going to be okay with waste, fraud, and abuse. And the way they've coined that phrase, waste, fraud, and abuse, is really hard to argue with. It's brilliant. It's absolutely brilliant. But at the end of the day, that's about the only thing I see cut or being attempted to cut in the current bill, in its current form. Now, when it goes to the Senate and they pass their version, and then we've got the reconciliation and they have to work it all out, who knows what we're really going to see when it's all over with. But suffice it to say, this administration is trying to grow their way out of debt. They're not trying to cut their way out of debt. And I'm not going to say that that's not smart, because I don't think there's a political will to cut. It's like with anything in government, once you give it out, it's hard to taketh it away, right? Once you start Obamacare, I cringed the day that that was signed into law because I knew it'd never get taken out. It would never get cut. It would be codified forever, and it probably is. In fact, you don't even hear the right talking about trying to get rid of Obamacare. Now it's just there. It's there forever. Just like Social Security, just like everything. Government. I've always said years ago when I was a young man, if there were a way, if there were a form I could fill out to opt out of Social Security and take my money rather than giving it to the government to invest on my behalf and give back to me in the form of a tiny little pension, let me just keep all my money. I'll invest my money and I'll get what I get. I would have been happy to sign that form because Social Security was maybe great. I wasn't around then, but maybe it was great. Maybe it wasn't for the time. But that time has passed, like daylight savings time, for God's sake. It may have been great when it was passed for the purpose it was passed for, but that time is gone. We can't get rid of that either, by the way. We can't get consensus in government for getting rid of anything. So the idea that we could see the left and the right, or even a polarity of one or the other, go in and cut dramatically enough to cut $2 trillion a year out of our expenditures, it isn't going to happen. It just isn't going to happen. And I think the only opportunity we have as a nation for our fiscal, for the health of the country economically, is to grow our way out of this debt. It'd be wonderful if we could see some cuts to go along with it, but don't hold your breath because I don't think we're going to see it. And Doge saving us 170 billion, if in fact that's an accurate number, that's a drop in the bucket to the 2 trillion or 1.9 that we are currently spending over and above what we take in revenue. So if the plan is to grow our way out of this mess and get to a fiscally responsible place again, what does that look like if you're the current administration? I think there's several prongs to this thing, and I'm not hearing anybody putting them together in the mainstream media. So I'm going to put it together for you the way I see it, right or wrong. I don't have a crystal ball, and certainly nobody in the administration is texting me with their plans. But it's pretty obvious to me that Trump wants us to have a resurgence in manufacturing in this country. And that's where the tariffs come in. A resurgence in manufacturing. He's going to tariff the heck out of anybody that is keeping American manufacturers and farmers and ranchers out of their country. If we can't do business in their country, he's saying, hey, then you can't do business in ours, and we have a bigger market than you do. And he can pretty much say that to everybody in the world. We have a bigger buying market than anybody else in the world. So if you're going to restrict our farmers and ranchers from sending beef to your country, you're going to restrict our farmers and ranchers from sending wheat to your country, or you're going to restrict our automakers from sending cars to your country by putting these huge tariffs on them, or undue burdensome regulations, or any of the other little manipulative things that a nation will use to protect against foreign competition for their domestic companies. He says, look, if you're going to do that to us, we're going to do you the same way, and we're not even going to be bashful about it. You know what, China? Let's put 100% or 135% tariff on your crap, and let's see how much of it we buy. Well, you know what? It got their attention, and it got them to the negotiating table. Now, Wall Street is calling that tumultuous, is calling that knee jerk, is calling that a lot of things. I don't think it's any of those things. I don't think it's knee jerk at all. I think it was designed to be so burdensome that anybody that was going to sit back and say, we don't need you, it was going to break them. And it broke them. It broke the Chinese. They blinked quickly and they came to the negotiating table. Now, we don't have a deal yet. I don't know what it's going to look like when we do get one, but I can tell you it brought them to the table. And I think you're going to see a lot of deals being signed. Now, we've already seen some. We've seen the UK deal. We've seen a couple of others. I think we're going to see more and more of them in the coming weeks. And as we start seeing those deals, I think the tariff fear is going to go away, or at least it's going to be lessened greatly. Now, the other prong to that is tariffs bring in money for the Treasury. So look, it's a win-win. If we slap tariffs on countries that have slapped tariffs on us already, and by the way, previous administrations have just sucked it up and took it. And they're like, oh, okay, you're going to tariff us 35% on American automobiles in your country? Okay. But we're not going to do anything to you. You can send your stuff here and we'll sell it. We'll let you sell it. But Trump's just like, no, that's not right. And he's right. It's not right. It's not right at all. So it's a win-win situation, really. If the tariffs bring them to the negotiating table and we get a fair deal for both sides, that's great, because that opens the door to that market for our manufacturers, our farmers, and our ranchers. If it doesn't, if they don't come to the table or they don't negotiate a fair deal, then we just have a massive tariff on them like they have on us. And that just brings in a lot of extra money to the U.S. Treasury to offset this $2 trillion deficit each year. That's not a bad thing, right? If we can start whittling down that 36 trillion in debt, that would be even a better thing. So we'll see. Last month, U.S. Treasury brought in more dollars through tariffs than it's ever brought in history. That's a good thing. That's not a bad thing. So I think the tariffs can go either way, but either one's good. Now, is it true that tariffs add a cost to Americans buying foreign goods? Yes, it is true. If the Americans continue to buy that particular foreign good. Now, I'll pick on a vehicle I own. I own a Land Rover Defender 90, okay? Made in the UK, shipped over here from the UK. If the UK had not done a deal with the United States for trade, let's say that the United States threw a 35% tariff on that vehicle. You think I'd have bought that car? Absolutely not. Absolutely not. I would have found something else to buy. And that's the key with tariffs. It does not add to the cost for the American consumer unless they decide that they still want to buy that product. And I promise you, a lot of people will decide otherwise. They will decide on another foreign product with a lesser tariff, or they'll decide on an American product with no tariff. Those are options that we'll have. But the tariffs are a great tool to bring people to the bargaining table or to bring in revenue to the Treasury to offset these huge deficits that we're running. So enough on tariffs. I think the other thing about the tariffs is when you combine that with the tax proposed tax bill, the one big, beautiful bill, there are a lot of provisions in there that also kind of slide in with tariffs to increase American manufacturing. You've got the bonus depreciation that's back on the table, and in a big way, a very big way. And then you've also got for purchase and expansion of factories and building of new factories. You've got huge tax incentives there as well. I think the administration is sending a very clear message that American manufacturing is back and it's going to be better than before. And it's going to look now with automation and AI and all of these things, we have got so much more technology available to us today than we had when American manufacturing died in this country back in the 70s and 80s. It's a different world with completely different technology. So I think it is a perfect time for us to reset, recalibrate, and launch this new golden age of manufacturing that Trump talks about. That's my take on it. We'll see where it goes. We should know before the next State of the Market update next month where the big, beautiful bill stands and whether it's still big, whether it's still beautiful. And then we'll also, by then, know how many more trade deals we've been able to land, how many more deals have been signed, and how many more are being talked about and negotiated. And I think as this all plays out over the next couple of months, by July 4th, that's my prediction, by July 4th, we're going to have a lot more clarity on where things stand in this country economically. And I think at that time, we're going to see a lot of businesses start making moves based on that clarity. And my prediction, again, I don't have a crystal ball, but my prediction is we're going to see a huge, huge boom of new plants, new expansion, new business formation, and so forth. So today, word of the day is fear. And I don't think that's going to be the case 2 months from now when we do this podcast at that point. A couple of other things in news today, too, on the state of the market. A very interesting article in the Wall Street Journal today. The SEC chairman, Paul Atkins, says he wants to expand access for non-accredited investors. Now, this is my wording, not his. I'm not paraphrasing. But he wants to expand access to private investments to retail investors that are not, by SEC definition or IRS definition, accredited. So the term accredited investor is used by those of us that have private investment funds. And basically what it means is particular types of funds that we set up, exemption Cs, for example, that those we're only allowed to accept accredited investors. And by definition, an accredited investor is somebody that has $1 million net worth with the exclusion of their primary residence, or they make, I think on a joint tax return basis, $300,000 a year, and individually $200,000 a year for the last 2 years, and are reasonably expected to do so in current year. So somebody can meet this accredited investor definition by any of those three ways, either in individual income, joint income, or net worth, excluding the primary residence. And what Secretary Atkins, or Chairman rather, Atkins is saying is that he wants to expand access for investors that don't meet any of those three. In fact, there was even talk in the article, not by him, but some in his staff, about eliminating that definition completely and saying, why do we even have that? And I've said that for years. Why are my funds that I offer only available to the quote unquote wealthy? Why can I only offer my funds to the wealthy? How is that fair to other people that want to diversify and, get into things outside of Wall Street, for example, and maybe in their hometown or maybe with somebody that they know and have a relationship with, but they can't because they're not wealthy yet by the by the definition, accredited investor. So it'll be interesting to watch that play out and see what Chairman Atkins comes up with there. Of course, being government, federal government, that is, they will have to go through public comment and all of this stuff before we're ever going to see anything change. But it will be interesting to watch. So that is the state of the market as I see it on May 19, 2025. Appreciate you listening. And as always, we'll see you on the next podcast, and we'll see you at the top. Thanks for joining us on The Invested Mindset. To continue receiving actionable wealth building strategies, subscribe on Apple Podcasts, Spotify, or wherever you listen to podcasts. Turn on the auto download to ensure you never miss an episode. And if today's insights moved you closer to financial freedom, please take a moment to leave us a rating. It helps fellow entrepreneurs and investors discover these valuable strategies. I'm Tom Berry, and I'll see you next time as we continue building the path to lasting wealth and freedom.